Welcome back to Wages and Employment at Wilfrid Laurier University. Today we are going to take a first look at some key labor market outcomes in Canada. For reference, you should pair this video with reading chapter 1 of your textbook. Now, there are many incomes that we're interested in when we look at the labor market, but we tend to start by looking at earnings. Why earnings? It's the main type of income for families, and it's what we need to buy stuff that makes us happy. So we are very specific about what we mean by earnings when you're talking amongst labor economists. When we talk about earnings, we're talking about that income that you get by selling your labor services. So you're going to work either as a paid employee or as a self-employed person, and you're getting paid, whether it be by the hour or as part of an annual salary. Now, we can measure that earnings in many different ways. We can do that on an hourly basis. We can do it on a weekly basis. We often do it on an annual basis. But in any case, it's earnings that we tend to focus on. Now, we make sure that we make this distinct from non-labor income. It's an odd term, it's one that labor economists use. When we talk about non-labor income, we are talking about that kind of income you get from something like investments. You have a term deposit that's earning interest. You're not working to get that money. You also have anything from government transfers that may or may not depend on how much you earn, but you don't in and of itself work for that money. Now, there's a few types of income that kind of fit into a gray area. One of those, for example, is pension income. This is sometimes treated as non-labor income, but really it's not. Pension income is often considered deferred earnings. So here we have in mind a pension that is closely tied to your own contributions that might be made by employees or employers while people are working. This is distinct from something like old age security, which has nothing to do with your work history. We wouldn't consider that earnings at all. So we sometimes have a few confusing definitions in here, but primarily we are going to focus on earnings. Now, when we look at income in Canada, we see that most people do have some positive earnings. Where do Canadians get their income? Here I pulled out the numbers from 2017. It's very similar to table 1.1, the statistics in your textbook. Now, as I said, most people's income comes from their earnings. 86% of men and 79% of women had at least some positive earnings in 2017. You'll notice here that after-tax income is actually higher for women than men in 2017 by a few $1,000s here. Now, this is because Canadians tend to send benefit checks associated with kids directly to the moms instead of dads in a family. So if you started just sending those checks to dad instead, that after-tax income difference would largely disappear. Now, a big part of the difference here between the annual earnings of men and women is that men, on average, work more hours over the year. Here we have a difference of about $400 or 400 hours, sorry. Now, notice that if you were to work 52 weeks of the year at 40 hours per week, that adds up to 2,080 hours, and many people are working much less than that. Here in this average, when we bring that all together, the zeros are included. Some people don't work at all, but there's also many people working either part-time or just part of the year. Now, another big part of the difference between men and women is the wage that they earn per hour. Here we see that in 2017, women were earning about $6 less than men. And over the course of a year, that's going to add up quite a bit. Now, to describe earnings, averages are not always the best option. So we tend to use a variety of measures and think about what distributions of earnings look like. Now, you'll often see labor economists refer to percentiles. You might remember seeing these in some of your other courses. Here, when we look at the 10th percentile of earnings, we're looking at a number where 10% of individuals have earnings below that threshold. The median is our 50th percentile, and then a 90th percentile is telling us that 10% of individuals have earnings above that threshold. Now, it's also very common for us to focus on the median instead of averages when we're talking about earnings and their distribution. The main reason for that is that they can be very, very different. When we look at something that is a normal distribution, you think about that bell-shaped distribution that you saw in your statistics courses, that's a case where your average will be equal to your median. It doesn't really matter which one you're talking about. But when we look at earnings distributions, you'll see that most of those are right skewed. And in that case, that average is going to get pulled up by any outliers in the very high earnings numbers so that our average is going to be greater than the median. So we often focus on the median. Now, we also like to talk about income dispersion. You might have noticed in the past few years, there's been a lot of attention on inequality in the labor market. And in that conversation, you will see people compare the 90th percentile to the 10th percentile. Sometimes that's as a log difference, sometimes it's presented as a ratio. Now, let's take a look at the earnings distribution in Canada. This figure is very similar to figure 1.1 in the textbook, but it represents the 2017 earnings distribution. Notice that when in creating this distribution, I took out anyone with zero earnings, just so we didn't have that big lump of zero there on your left-hand side of that distribution. The distribution itself is right skewed. Notice that it peaks right around $25,000 per year, and there's very few people who are earning more than $200,000 per year. We also want to get a sense of what is typical when we look at these distributions. Here we see that the median annual earnings is just under $50,000 per year. And when we're thinking about how spread out this distribution is, we see that if people are earning more than $100,000 per year in 2017, they are among the top 10% of earners in Canada. So you can always keep these numbers in mind when you start heading out looking for jobs. Where would you place in this distribution? But those annual earnings are masking big differences in the hours people work within the year. Now this figure is similar to figure 1.2 in your text, presenting the 2017 numbers. Median hours worked is just under 2,000 hours per year. That's working full-time all year long. So for example, your professors are officially paid for 35 hours per week. So we're paid for 1,820 hours every year. If you were paid to work 40 hours per week, that adds up to 2,080 hours for the year. Very few people are working very much more than that. Now, most of the skewed distribution in earnings reflects a skewed distribution in hourly rates of pay. The Canadian Income Survey used here to create this figure, similar to figure 1.3 in your text, it doesn't report an hourly wage directly. Instead, we have to figure out what people earned on average based on their annual earnings and hours reported. Now here we see that on average, Canadians earned $33.62 per hour, but the distribution itself is very skewed to the right. And so the median wage is actually much lower than your average wage. The median wage here is only $24.61. That's a pretty big gap. Now, when we start thinking about inequality, we look at the 90th and 10th percentiles of wages. We see nearly a $43 difference there. Put differently, the person at the top 10% threshold is earning nearly 5 times the wage of the person at the bottom 10% threshold. And we would tend to think of that as reasonably large, but usually you want some context to really think about whether or not that's a big or small difference between your 90th and 10th percentiles. Now, before we move on to the next few chapters, we want to have some key concepts fairly well defined. So first, we want to make sure that everyone who is talked about as employed is somebody who is working for pay. Can't just have a job lined up, planning to work, anything like that. You have to be working and you have to be paid for it. If you are engaged in something like home production and you're not paid for it, we don't count you as employed. If you are unemployed, you are not working, but you are searching and you are available for employment. Available means that an employer could call you up right now and you are ready to go to work. So you can't possibly have kids sitting around you that you don't have childcare available for. Now, finally, a labor force participant is someone who is either employed or unemployed. You have to fit into one of those two categories. Everyone else who's not working or not searching for a job, they are considered non-participants, or they are not in the labor force. Now, when we bring these together, we have different rates that we commonly see in the data. One often presented is the employment rate. This is the number of people who are employed out of the population. The unemployment rate is the number of people unemployed out of the labor force. And I want to emphasize the difference in the denominator of those two rates. Commonly, we see those two numbers simply added. They will never add up to 100%, at least not normally. We cannot add those two in any way that is sensible. So I just want to emphasize that point so that you don't end up doing that in the future. Now, next time in our next video, we will be introducing the neoclassical model of supply and demand for labor. See you then.